The richest investors aren't necessarily buying multiple apartments. Many are also investing in premium commercial real estate, office parks, and income generating assets.
They offer the benefit of both a debt instrument and an equity instrument. Now, this is one instrument which is actually giving you the best of both worlds in terms of giving you regular income as well as growth with limited risk. So you're getting exposure to a much larger diversified portfolio by just investing as small as even $500. If you're talking about just 12 months, I can talk about Mindspace REIT has given more than 30% return in the last 12 months with
Does this
very
include
limited
distributions?
including distribution plus growth in the stock price. So both put together is 30% plus, and that too with very limited risk profile.
So folks, 30% return the last 1 year with much lesser volatility, much lesser risk. Sounds too good to be true, right? For many years, real estate has been a preferred asset class of the wealthy Indians. But here's something very interesting. The richest investors aren't necessarily buying multiple apartments. Many are also investing in premium commercial real estate, office parks, and income generating assets. And most retail investors never get access to this. So how do they do it, right? And more importantly, how can everyday investors learn from this? And that's what we're here to discuss today. And to do that, we're joined by Preeti Chheda. She's the CFO at Mindspace REIT and also an executive committee member at the Indian REITs Association. She comes with over 2 decades of work ex. Welcome, Preeti.
Thank you.
Glad to have you here.
Thank you.
So, but before we begin, can you give us a little background and some idea on what is exactly REIT and how does it function?
Right. Firstly, thank you for having me here. So REITs are vehicles which actually house largely completed assets, which distribute 90% of their cash flows as mandated by SEBI and also offer growth. So all this while we have heard of real estate assets as physical assets. All of us invest in those assets because India generally likes to own physical assets. This instrument is actually providing liquidity to those physical assets. So they are similar to, I would say, mutual fund in terms of their structure. They operate like operating companies, but I would say they offer the benefit of both a debt instrument and an equity instrument. And the reason I say that because similar to debt instrument, it makes regular payouts mandated by SEBI, as I said, 90%. And it also offers growth because real estate is an appreciating asset. So as the value of those assets appreciate, as rentals keep growing, the yields which are given to the investors, those also start growing. So it's actually filling the gap which was in India for a very long time. So you either had fixed instruments, fixed income instruments, or you had equity. Now, this is one instrument which is actually giving you the best of both worlds in terms of giving you regular income as well as growth with limited risk. That's how I would sum up this instrument.
More importantly, they're without having to worry about admin and maintenance.
Absolutely,
headaches.
yes.
So, Preeti, if one were to compare the pros and cons of actually buying a building versus buying a REIT, how would you put it, the pros and cons?
Right. So as I said, historically, all of us have experienced buying real estate asset. So say, for example, whether you're owning a residential property or you're owning an office, first and foremost, you have to make sure that, especially if it's an office, you need to rent the office, you have to maintain, you have to make sure the rent is collected in time. You will at best be able to own an asset or say an office in a particular locality, in a city. Plus, if you want to ever sell it, you can't just sell it overnight. You can't wake up one morning and say, I want to liquidate this instrument, go and liquidate it. Now, all of those issues are taken care of by a REIT. So REIT owns similar properties, but of course in a very much larger scale. It's not about one floor somewhere or one unit somewhere. We have large parks on a pan-India basis, so they offer diversification. They take care of the liquidity issue because REITs are listed on stock exchanges and you can actually go ahead and buy even a single unit at any point in time. So you're getting exposure to a much larger diversified portfolio by just investing as small as even $500. And you can actually get those benefits. You have a professional property manager who's taking care of managing those assets, keeping them at par with what you see in the market. And these assets are evolving every day. An asset which you made maybe 10 years back may not be the same as it's today. So we keep spending a lot of money in upgrading and getting them to what the millennials today need. You provide liquidity, we maintain, you have professionalism that comes, and it allows you to keep growing that portfolio because we keep looking at how do you grow the rent, how do you upkeep those assets, how do you keep turning the tenants, how do you get more tenants, different diversification in terms of tenants. So all these are benefits which actually the REIT offers, which you would otherwise not see when you're actually buying a physical asset.
Right. So it's also more like hiring a professional property manager.
Absolutely. Yes.
Yeah. So, folks, this becomes more important because, like Preeti mentioned, when you invest in a commercial real estate, it is limited to one particular location.
Yes.
And also, it becomes more important because the properties that a REIT manages is investing into multiple sectors, right? Like
Yes.
they lease out to multiple sectors like healthcare, IT, all that. So, if you
Correct.
could give a breakup of Mindspace, how does it, in which sectors it is spread across?
Right. So before I answer that question, you rightly said REITs could be across various sectors. For anything to become a REIT, you actually need a real asset. It could be any asset, it could be real estate, or it could be in an infra asset, because we have something called INVITs. If it's an infra, we call it an infra INVIT. And if it's real estate, we call it REIT. So it could be any asset. It could be office, it could be a mall, it could be a hotel, it could be roads, transmission lines, warehouse, data centers. Any and anything which is generating rent or income can actually qualify as a REIT. Specifically talking about Mindspace REIT, especially in office sector. So we actually invest in offices, and of course in our portfolio we also have data center. A small portion of our is also data center. We also have hotels, but we do a rental model. We don't run the hotels, but we actually build hotels and rent to hotel operating companies. So, but I would say predominantly we are an office REIT. But in India, for example, we have 5 office REITs and we have 1 shopping center REIT. And we have multiple asset classes under the InvITs. So we have multiple infra assets which are already sitting in the InvIT. So like today we have 6 REITs and InvITs, and we are almost 25 plus InvITs. So 6 REITs and 25 odd InvITs.
Right. To sum it up, so REIT takes care of your liquidity issue, your diversification issue, as well as diversification across the sectors. Yeah. So.
And actually, people can pick and choose what exposure they want. If somebody likes exposure to office, then you have office REITs. If somebody wants exposure to malls, then they pick up a mall REIT.
Right. More importantly, you have the regulatory backing because the REITs are regulated by SEBI. That becomes more important. Let's also talk about the hidden cost, and the expenses that come along with owning an actual real estate, a commercial real estate versus REIT. How does it compare? How do you see them?
Right. So when you're owning commercial real estate, obviously the biggest expense for you will be maintaining that asset. You actually have to have somebody, obviously all of us don't have the wherewithal to go and maintain assets, especially if they are of a particular size. So that's of course one. Then you have things like you have to pay your property taxes. Maintenance takes a lot of time, not just money, but it also takes a lot of time. You have to keep, every time a tenant is churning, you need to pay brokerage to get the tenants. And generally we experience that when you have smaller areas which you own, then the churn is also much more.
So Preeti, if I were to trouble you to take an approximate example, not
Right.
exactly, between an investor owning a commercial real estate versus a REIT, how does the expense and cost come along, including upfront and running both?
So REITs also incur similar expenses, but what happens is we have the economies of scale because our portfolios are large portfolios. We 20 million, 30 million, 40 million square feet. So even though we also incur maintenance expenses, but we have economies of scale when we do our maintenance versus somebody who's just owning 1,000, 10,000 square feet. Taxes we also pay, so that's such there's no difference. But I think a big important thing is we have economies of scale, and the most important thing, we have that professional expertise to manage those assets as compared to what an individual would manage. So that economies actually brings in economies plus efficiency, which otherwise you will not find when you and I are just simply buying an asset and managing ourselves.
Correct. Also, folks, when you invest in a physical real estate, you incur a lot of costs such as registration, stamp duty, maintenance, broking charges, and sometimes if you were to liquidate it, you might have to wait for weeks and days or months sometimes. All of that is solved with the REIT, and all of that is summed up in one cost called as expense ratio, which isn't much. Is there a headroom to, is there a max limit to of what is, if you were
So I would say generally if your rent is say $100, you can actually have 5% in terms of expenses, and 95% is net of expenses, which we call something called net operating income. NOI is a term which we generally use in context of REITs, and that's nothing but your rent minus the expenses which you incur in relation to the property. So generally your NOI is almost 95% of your rent. So if you were to look at the expenses, it will be 5% and everything else is NOI.
Right. So now let's talk about the most interesting thing which has happened in the last 1 year, right? So from a diversification point of view, Indian equity investors haven't had have a easy ride. Nifty has been broadly flat in the last 1 year with approximately 3% negative return in the last 1 year, with plenty of volatility along the way. But interestingly, REITs have delivered positive, even double-digit return, not just positive during the same period. Could you tell us more about what role REITs play from an asset allocation point of view? The idea of having uncorrelated assets in times like these.
Right. A very, I would say, interesting question. And this is exactly how we position these instruments, and that's exactly how we tell all investors. We are not telling that this instrument should replace equity or debt or any other investment class. We've always said that this is also an important asset class for any investor to have in their portfolio, because this is giving you the benefit of both regular income as well as growth. And you rightly said, this is an instrument which comes with medium risk, medium return. When I say medium return, the kind of returns that REITs have delivered, I would say, in the last 6 odd years,
Yeah.
they're not medium by any stretch of
Yeah.
imagination. We've actually given 15% plus returns.
Right.
And if you're talking about just 12 months, I can talk about Mindspace REIT has given more than 30% return in the last 12 months with
Does this
very
include
limited
distributions?
including distribution plus growth in the stock price. So both put together is 30% plus, and that too with very limited risk profile. So
Right.
that's the beauty of these instruments. People always say, and they start comparing us with equity, and we always tell, even if you compare with equity, obviously we have only a 6-year track record. Equity has years and years of
Years of time.
track record. But even if you compare equity returns over say 10 or 20 years, we can actually compare with the same kind of returns which
Right.
we've delivered in 6 with much lesser risk.
Right.
So these instruments, if you look at internationally, are also good from a, I would say, hedge against volatility. That's
Right.
how these instruments are looked, because the volatility in these instruments is pretty range bound. So even when the markets are going up and down, these instruments are behaving in a very range bound manner. So you are getting the
Right.
benefit of low volatility and actually returns which are, I would say, very attractive.
Right. So folks, 30% return the last 1 year with much lesser volatility, much lesser risk. Sounds too good to be true, right? So that brings us to the next question. India has handful of REITs, whereas internationally, as you said, this
Yeah.
asset class has very evolved, quite a lot. So what is stopping this asset class to, grow in India? And if you had to make one bull case and one bear case for Indian REITs, what would each look like?
So I think we have made a very good progress in the last 8-9 years of REIT InvIT existence. Just to give you the scale, between REITs and InvITs, today we manage almost 10 lakh crore of assets.
That's massive.
So it's not small, because in 9 years to achieve this feat, I think it's commendable, because
10
getting
lakh
to
crores is all listed. Huh.
yeah, I mean, every REIT has to be, REIT or InvIT, they have to be listed. You don't have a concept of unlisted REITs or InvITs. So that's number one. So we have achieved the scale. And I think it's very important to note that we have achieved the scale across sectors. So if you look at REITs, while it's only office or retail, but on the infra side, it's been roads, it's been transmission lines, warehousing, and so on and so forth. So I think that's not all jurisdictions or globally have been able to achieve this kind of feat. Now the question is, when do we see more of them? I think it's more to do with education. I think it's more about awareness, because it's a new instrument and India has not seen this instrument for a very long time. I think it's more to do with creating that kind of awareness amongst not just investors, but amongst asset owners also. So now you actually have more and more asset owners, even who have smaller portfolios, are actually thinking, can they actually do a REIT? And if you know, SEBI has come out with a concept of SM REIT, which is small and medium REITs. And that's exactly to facilitate asset owners which have smaller pool of assets to also use these platforms. And therefore, if you have assets which are between say 50 and 500 crore, you can actually do a small or medium REIT. So I think this is a phase which will only get bigger and bigger. You'll have more asset classes also coming into the REIT, and the existing asset classes also will start growing bigger. Because if you look at just office, in India we have today REITable stock of almost 400 to 500 million square feet. About I would say 200 odd million square feet has come into the REIT today. The balance will at some point in time come in. Same with malls. Hotels, we've not really seen a hotel REIT, and many other asset classes, data center, warehousing, and so on and so forth. So I think it's only about evolution. It's a journey. You will keep seeing more and more of these coming into mainstream REITs.
Right. And one bear case, like what could really be a big challenge?
I don't think there are any, I would say, visible challenges if I were to say. I think we have, from a regulatory standpoint, a very robust regulation which has created so much of trust amongst investors for this instrument. I think whether it regulatory, when I say SEBI regulation or taxation, the only risk, if at all, is business risk. But again, as I said, it's a very diversified portfolio. Today, all of us have diversification, while even if it's a single asset class, say as is only office or a mall or so, we have pan-India presence. We have, the clients are very different, like we have almost 50% plus of our portfolio GCCs, which is a very growing segment. So I said within an asset class also, there are diversification which is getting achieved in various forms and shapes. So I think I really don't see any visible downside to this product at the moment, but there are enough of upsides as we go along.
Okay, fair. Now, so some questions from a point of view that how a retail investor should evaluate a REIT, right? There are some metrics which I was reading while for this interview, like what metrics should a retail investor look at while purchasing a REIT, like occupancy ratio, WALE, LTV, or the yield. Could you decode some of these metrics and for example, in equity stocks, it is easy. One can look at a P ratio or whatever, compare the price. So how do these metrics?
Right.
How do I know that I'm buying a good REIT?
Right. So I think 2-3 things. So fundamentally, first you have to make up your mind which asset class do you want to take exposure to. So that will be your first decision point. Second, say if you decide an office asset class, so that's your first decision point. Now within office, you have to decide where do I want exposure to. I want pan-India, then you look at players which have pan-India presence. Almost all REITs today fortunately have pan-India presence, so that decision is much more easier. Comes to financial metrics, as I said, we are a yield plus growth product. So yield is an important metrics, that the kind of distributions which a REIT is making, that's one important metrics. We called it distribution yield or DPU, distribution per unit. So that's one important metric which any investor should be looking at. DPU. Second is a total return. That's very important because in India, REITs are not just giving yield, but they are actually giving you growth, which is coming by way of appreciation of the price.
M2M growth.
Mark-to-market growth in rent, which translates, if you look at in an efficient market, that translates even to the stock price growth. That's why you've seen all the REIT seeing the stock price appreciation also. So total return is something which is very critical, because when I say REITs have delivered 14, 15 plus returns, it's a combination of your DPU yield plus growth in the stock price. So total return also is an important parameter which every investor should keep in mind, because yield plus the stock price appreciation, which we call total unit holder return, that's again an important metrics. Of course, from a business standpoint, your occupancy is very important, because 80% of a portfolio has to be completed and rent generating under the REIT regulation. So occupancy becomes extremely important. NOI growth, as I said, net operating income, that's actually rent minus your expenses. How NOI is going to grow, that again becomes a very important metric. So to sum up, not to confuse, from a business standpoint, occupancy, how your NOI growth is important. From a return perspective, the distribution yield and the stock price appreciation, both of them culminate into total shareholder return or total unit holder in this case. That's very critical. And you have enough data available in public domain for investors to actually make informed decisions.
Right. So coming to last, few things like tax and compliance. From a compliance standpoint, REITs have to be reported separately in your income tax returns. But could you brief us about how are REITs tax its distribution, various components of these?
Right. On the face of it may sound very complex, but I'll just break it up to make it simple. So there are essentially 3 components of distributions that a REIT makes. So distribution comes in 3 forms. First is dividend. The second one is what we call return of capital. And the third one is interest. Dividend is tax exempt if the SPVs, which are sitting in the REIT, opt for taxation under the old tax regime. And almost all REITs today have opted for the old tax regime. So not confusing, dividend is fully tax-free, and I think that is a USP of this instrument. Today, if you're getting dividend from any other company, you pay full tax, but if you're getting dividend from a REIT, the investors don't pay any tax. So that's number one. Then a component comes by way of interest, which is fully taxable at a marginal rate of tax. Return of capital is another mode in which distribution happens. all that you need to simply do is reduce the amount of distribution that comes by way of return of capital from your cost of acquisition. Say you bought an unit at 300 rupees and a REIT is giving you 5 rupees by way of return of capital. You only reduce 300 minus 5, so your cost of acquisition today is 295. And so if you sell the unit at 400 rupees, then you pay capital gain tax on 400 minus 295 and not 400 minus 300.
Right.
So when you receive the distribution by way of return of capital, you pay no tax at all. Only when you sell the unit, you land up paying the difference, which is effectively capital gain tax.
Right.
So again, just to sum up, 3 components: dividend, tax-free; interest, fully taxed; return of capital, don't pay anything when you receive it, only reduce from your cost of acquisition. So effectively, you pay only when you sell, you pay capital gain tax. Right. So I think I would say these instruments are very tax efficient instruments also, because these are income distribution kind of products. That's the reason they carry these tax efficiencies.
Correct. And if I'm not wrong, the large portion of the distribution is dividend.
Yeah. So for REITs, a large portion is coming by way of, so if I were to talk of Mindspace REIT, almost 50% plus comes by way of distribution, by way of dividend.
Right. And all of it is tax-free in the hands of investor, because the underlying SPV has opted for the old regime.
Correct.
Which means it pays tax on its own level.
And it pays higher than what companies
investor
pay in the newer tax regime.
Correct. So Preeti, I might put you in a tough position with this last question. If a retail investor or an investor wants to access REIT, what is an ideal way? Should they go and exchange and buy REITs, or should they pick a mutual fund? Of course, mutual funds today do not largely have significant exposure to REITs. Or should they all go for AIFs? Of course, it comes with a higher ticket size, who invest or feed into REITs.
Right. So like any other stock investment, you have the option to go do your own research and pick up a REIT yourself. Or for people who say we don't have time or the bandwidth, or we don't understand all of this, in so much of depth, we would prefer to go an AIF or a mutual fund route. That's a similar thing with REITs also. So either you go ahead and buy it, similar to buying any stock, because you can just go on your any other website, broking website, and similar to if you have a demat account, you can just go and even buy a single unit also online. So that's an option available with all investors. And I think I should be saying here that the amount of disclosures that REITs make, it's far more than any normal company, because SEBI actually has a mandate of the kind of disclosures that REITs have to make. So if you just go and open a presentation by any REIT, you will see the quantum and the amount of disclosures that REITs make. So from a decision-making point, because so much information is disclosed, we do half-yearly evaluations. So there's a lot of information available for individual investors if they want to read and invest themselves. Or otherwise, of course, you have mutual fund. And I should be saying that mutual funds have actually invested a whole lot of money in REITs. So today I would say almost 30,000 crore plus has come into REITs across different schemes. So you have money which has come from equity schemes, from balance funds, and across thematic. So there is enough of mutual fund money. So investment can happen through mutual funds, and now in fact you have some REIT in with dedicated mutual fund schemes also coming on board. So if somebody wants only exposure to REITs and InvITs, then you have those schemes also to access. So it could be through different means depending on what suits a particular investor.
Correct. So NSE has launched an index, I guess, on REITs and Invest.
Yes.
So we can see more mutual funds in the coming future which only invest in REITs and Invest.
And in fact, that will also enable passive money to come in, because by enabling inclusion in indices, you will actually have ETFs, index funds accessing these instruments.
Correct.
So you'll actually have more passive money also which will flow into these instruments.
Right. So Preeti, thank you so much for your
Pleasure.
time. Thank you so much for this conversation.
Thank you so much.